Welcome back. Let's talk to a firm favourite here, Marc Ostwald. He's a strategist at ADMISI. Morning to you, Marc.
Good morning.
Headline: S&P biggest fall since July. S&P sold off, biggest daily percentage drop in 3 months as escalating worries about the Trump administration's ability to push through its economic agenda rattled investors. We've had a number of technicians come on the show this week suggesting that there's a potential top here. We've seen Bank of America Merrill Lynch saying Q4, everything's in place for some sort of correction. What are your thoughts?
Well, let's have a look at the other side of the coin, because really what's driving the strength in equities wherever you look is the fact that bond yields, be they government bond yields, be they corporate bond yields, be they high yield or emerging market bond yields, are extraordinarily low. And therefore, when you look at the risk reward, you look at the potential for both capital appreciation in the equity market and the fact that dividend yields in many cases are much better than bond yields, particularly a corporate versus equity comparison. And you can see why we've got to where we have with the equity market. It may look overvalued, but fundamentally it's more a function of very, very low yields in the credit markets.
Okay.
So, yes, when one looks actually at the way that the S&P 500 has been trading, particularly, and the NASDAQ, and indeed the Dow, you start looking at the amount of gainers versus losers on a day, and you see that the market, the gains that we've had, really have no breadth whatsoever. So it does look like it's in for a correction. I think what's interesting is you've got all these people on the technical side calling the equity market down, and we've probably not had as many people warning that people should be starting to divest themselves of their high yield bonds. Now, for me, that's probably the more important aspect, in the sense that if people do start to heed that advice, and it's debatable because people still need to make returns and they're very hard to come by at the moment, and are likely to remain hard to come by, particularly if someone like San Francisco Fed boss John Williams saying, well, he reckons the new normal for interest rates is around 2.5%. So you're still never going to be making much money on your deposit accounts as a conservative investor. That said, we are vulnerable to a correction. I think it's interesting that we've had 2 Thursdays in a row, and it's happened both times on a Thursday.
Okay,
where
that's a nice bit of an analysis.
Where the equity market goes into turmoil. And of course, we've got the fears about Mr. Trump not delivering. I think there's an interesting debate there, because if you actually look at the run of economic numbers that we've had out of the United States, and you go, well, perhaps we don't really need a Trump bump. Do we need this extra stimulus? Yes, it would be nice, but actually the US economy is performing pretty well. So is it necessary? But with Mr. Trump basically really beleaguering the dollar, one has to worry that this restraint on positive investor sentiment is actually going to start to get hold. And we know that basically everyone's starting to get very, very long. And a lot of cash was put to work, which had been on the sidelines on the dip last week. If we have another dip, and we've got equity options expiry, the monthly one today, which this sort of down move that we're getting could make a little bit of a mess of, even though it's normally, being August, not really an equity options expiry that people take much notice of. So we're in a scenario, I think, where the market's definitely vulnerable to a correction. Will it be very, very sizable? Well, it'll only be sizable if we actually start seeing a proper sell-off in credit markets. Doesn't necessarily have to be in government bond markets, but definitely in credit. You need to see credit spreads, both investment grade and high yield, really start to widen quite significantly. And that would send a really poor signal for equity markets everywhere.
Understood. Marc, thank you very much indeed.